Welcome to the Deep Dive. Today we are opening up a topic that is often shrouded in a lot of complexity and jargon trading, but we're not here to chase complex indicators or, talk about quick profits. You're going to take a scalpel to the markets, really examine the fundamental building blocks, the DNA, if you will, of how price actually moves.
That's exactly right. And you've given us a really fascinating stack of sources for this one. It's a mix of high-level technical primers, the rough-and-tumble history of physical trading pits, and even some deep philosophical insights.
So what's the mission here?
The mission is really foundational. We want to give you a crystal-clear, actionable understanding of the core tenets that drive all market activity. It doesn't matter what the asset is.
We're cutting through the noise. We're starting with what one of our sources calls the pure essence of price action. And if you can master this one concept, everything else just gets infinitely simpler. Okay, so let's unpack this.
All right, so technical analysis, it begins and ends with the price chart. It's the visual record of an asset's price over a set period of time. And, while there are simple line charts, the candlestick chart it's the essential tool.
Because it tells a much more detailed story, right? It's not just connecting the dots of closing prices.
Exactly. It captures the conflict between buyers and sellers in one single visual element.
Okay, so to visualize this, the horizontal axis, the x-axis, that's time, right, moving left to right.
Yep, and the vertical axis, the y-axis, is the price scale.
But we really want to get into the narrative inside each of those candles.
That's the key. The true foundation for reading price action is this sequence: the open, high, low, and close, or OHLC.
And it's not just data points.
Yeah.
It maps the full journey of price.
It really does. I mean, the body of the candle and its wicks, those little shadows sticking out, that turns the data into a story of a battle.
So walk us through that. A down close, a bearish candle.
Okay, so a bearish candle. The price opens at the top of the body. Now, during that session, buyers might push it up a little bit to make a high that leaves a small upper wick.
But then the sellers take over.
The sellers dominate. They force the price down. Maybe they test a certain level to make a low, which leaves a lower wick, and then it closes below where it opened. That red or black body is showing you a net loss for that period.
And the bullish up-close candle is just the mirror image of that.
Exactly. It opens at the bottom of its body. Sellers might try to push it down to make a low, but then the buyers step in, they reject those lower prices, push it all the way up to a high, and finally it closes above that open.
So the wicks are basically showing where price was rejected.
That's the key distinction. The wicks are rejection, the body is conviction. And whether that sequence is open high low close or open low high close, it tells you who won the session.
And if you look at that across different time frames, say a 1-hour chart versus a daily chart, you get a much clearer picture.
You start to see the bigger picture, the momentum, and that helps you determine your bias.
And our sources were very, very clear on this. Bias isn't just a guess. It's your directional conviction. It's your anticipation of where price will likely go next, based on that higher time frame analysis.
Without a strong bias, all that OHLC information, it's just noise.
Okay, let's transition from that foundational candle structure to the bigger forces, the ones that govern the entire market ecosystem. Our sources all seem to converge on three concepts: liquidity, market efficiency, and price.
And it's so important to realize that liquidity and efficiency, these weren't just abstract terms thought up in a boardroom. They came from pure necessity.
You're talking about the origins of the futures market, like the Chicago Board of Trade.
Yeah, back in the 19th century. It was created to solve these really chaotic agricultural problems. I mean, you had seasonal supply issues, crazy price instability for farmers. It was a mess.
And that instability needed a stabilizer. It needed a middleman.
Enter the pit traders, the locals. They were the human embodiment of liquidity and market efficiency.
So what was their actual job?
They were market makers. So imagine a big financial firm has an order for, say, 5,000 contracts. They can't just dump that on the market.
It would crash the price.
It would cause chaos. So the pit traders, they would break down that massive order into smaller, bite-sized trades. They created a smooth flow, and they'd profit from the bid-ask spread.
That small difference between what buyers will pay and what sellers will accept.
Exactly. They made sure you could get your transaction done immediately and cheaply.
Okay, so that's liquidity in a physical pit with people yelling and signaling.
Yeah.
How does that translate to today's, fully electronic market? If the locals are gone, what's providing that speed now?
That's a great question. Today, it's all about the tightness of that bid-ask spread and the depth of the order book. High-frequency trading firms, automated algorithms, they've replaced the pit trader.
But the function is the same.
The function is identical to make sure you can get in or out of a huge position without seriously moving the price against yourself. If a market has low liquidity, your OHLC data becomes unreliable.
Which brings us to a more philosophical side of this. We have the mechanics OHLC, we have the structural needs liquidity, but one of our sources brought up George Soros and his idea of reflexivity.
Right, which is rooted in anthropology, not finance.
Why is that relevant? It seems like a huge leap.
It's powerful because it argues against the idea of a perfectly efficient market. Soros argued that the market isn't just a passive mirror of reality, it's an active participant in shaping it.
Okay, let's unpack that. What does that feedback loop actually look like in practice?
Well, it means that traders' expectations can actually change the fundamentals of a company, which then reinforces those original expectations.
Give us an example.
Sure. Let's say a bunch of traders believe a stock is undervalued, so they start buying it. That's the expectation.
Okay.
The buying drives the price up. That rising stock price then improves the company's balance sheet. Maybe it can raise capital more easily. That's the fundamental change. And that new, healthier fundamental validates the initial belief, drawing in even more buyers.
It's a self-reinforcing cycle.
A self-reinforcing and potentially self-defeating feedback loop. Soros's point was that trading is an art form. You have to use critical thinking to spot when these loops are starting, and more importantly, when they're about to break.
It's fascinating to go from that abstract idea to the intense physical reality of open outcry pit trading.
Yeah.
That's where you see the raw human pressure of it all.
Oh, the Chicago Board of Trade was. It was pure physical frenzy. But beneath the chaos was this incredibly rigorous nonverbal system of communication. You had to know the language.
The hand signals were just a marvel of efficiency.
They were. If you were buying, your palms faced in, like you were pulling something toward you.
And selling, palms out, pushing it away.
Right. And quantity was all signaled on your face. 1 to 5 contracts on the chin, 10 to 50 on the forehead, 60 to 90 on the side of your head.
Wow.
It was pure action and reaction. But the culture was aggressive. The mantra was that every trader was the president of their own company. You were totally responsible.
Accuracy was valued over just pure speed.
The paramount rule was check every single trade, because one mistake could wipe out your entire day, or worse.
It makes sense then that the switch to electronic trading, which basically killed the pits by 2015, was just devastating for so many of those guys.
They lost their greatest edge. They lost the nonverbal cues. They couldn't physically see the order flow anymore. They couldn't feel the fear or greed in the pit.
That whole informational advantage built on human observation, it's just vanished.
It's gone overnight. Now they're just watching numbers on a screen like everyone else.
That historical view on discipline and risk, it sets the stage perfectly for the ultimate cautionary tale. Lehman Brothers.
A firm with a 150-year history of adapting. They started as cotton traders, became this massive investment bank.
But by the 1970s, the culture there had a nickname, the Devil's Casino.
Yeah, known for just excessive risk-taking, a hyper-competitive, toxic internal environment. That culture was the critical flaw, long before the end.
And then you fast forward to 2007. The firm has its best year ever, $4.2 billion in profit, over $600 billion in assets.
But that massive scale hides the devastating leverage they were using.
Right.
The firm's actual equity, the money they actually owned, was only about $22 billion. They were leveraged almost 30 to 1.
So for every dollar of their own money, they'd borrowed almost 30.
Exactly. And this is the detail that people often miss. Subprime mortgages were only 3% of their total revenue in 2007. A tiny fraction.
So it wasn't the asset itself that was the problem.
It was the debt multiplier on the asset. The analogy is like buying a house with a 3% down payment. If the market drops by just 3%, you've lost 100% of your equity. You're wiped out.
And Lehman Brothers did that on an institutional scale.
They used so much leverage on that small piece of their business that a tiny drop in the housing market wiped out the entire foundation. And the result was the largest bankruptcy in history, the climax of the global financial crisis.
It just perfectly shows that failure in the market isn't always from some complex formula going wrong. It's usually a failure of basic discipline.
So, bringing this all back to you, the learner, how do we take that fundamental understanding of OHLC and apply it with the kind of precision and discipline that avoids that casino mindset?
We use the candle's internal structure to execute with precision. It lets you strip away all the lagging indicators
Hmm.
and make decisions based purely on what price is doing right now.
Okay, let's walk through that application. Let's say you have a strong bullish bias. You think the price is going higher. You don't just buy
What do
blindly.
you do?
You wait. You want to be buying long anytime price dips below the session's opening price.
That sounds counterintuitive. If you think it's going up, why would you buy when it's going down?
Because that dip below the open in a bullish market is often a liquidity grab. It's a temporary move to shake people out, to run their stops, but most importantly, it offers a better price for the big players to get in.
And when price gets rejected down there and moves back up, that confirms your bias.
It confirms your bias, and you've gotten in at an optimal entry point.
And the same logic applies in reverse for a bearish bias.
Exactly. If you think price is going down, you wait for a rally above the session's open. You use that brief moment of bullishness to get the absolute best price for your short position before the anticipated drop.
This requires an immense amount of self-control.
It does. One of our sources calls trading the most difficult human endeavor. It's not the math that gets people, it's the psychology. It demands true self-mastery.
Controlling fear, excitement, doubt.
All of it. Most people fail, and fail quickly, because they can't master their own emotions.
Which brings us to what might be the most crucial rule for anyone starting out on this journey.
Yes, stay in the demo stage for as long as possible. You have to treat your trading like a scientist running a simulation.
You're building a statistical edge, not just burning through your savings.
Right. And if you find yourself in a long losing streak, I don't mean a bad week, I mean months, you have to stop trading live funds immediately.
Because it means there's a fundamental flaw in your strategy or your mindset.
And continuing just risks your livelihood and builds up these costly emotional scars, that fear and hesitation that comes from making big mistakes. Demo trading removes that risk. It lets you test and improve without the pressure.
It's really the only way to genuinely master the discipline that's required.
So we've covered a lot of ground today. We've gone from the simple story of the open, high, low, and close,
To the huge market forces of liquidity and efficiency, and finally, the need for self-mastery.
right. You know now that to trade with precision, you have to master these basic elements and apply them with real discipline. It's about building a solid foundation.
Something that can actually stand the test of time, unlike those hyper-leveraged structures we talked about.
However, the sources did hint that these three tenets, liquidity, efficiency, and price, they're not quite complete on their own.
What do you mean?
They require a missing link. One source even called it the Higgs boson of trading, something to bridge them all together to unlock true consistency.
So for your ongoing study, consider this final thought. If the open, high, low, and close define the boundaries of price, and liquidity defines the opportunity, what unseen element, something you can't find on a standard indicator, is the true source of consistency? What allows a skilled trader to anticipate where price will find stability and move next? You've seen the foundation, now seek the bridge.